we got something pretty established. Whereas in the precision, you know, Galle is one day. I think we done one evaluation to finish. So today we have to take the evaluation also and also start. Anyway, we try. So I think this is we can do the fast because now you know what is this evaluation, right? Based on the concept you learn in the time of money, we are calculating intrinsic value. So when we say the intrinsic value, that is simply present value of the future expected cash flow of this particular security. So you need for one valuation. So based on the expected coupon and the expected selling price or the redemption price, we calculate the value. So now we have to discuss common stock or ordinary share valuation and the preference share valuation. So again the concept is same, so we are going to calculate intrinsic value. So based on the intrinsic value, again you can decide whether you invest or not by comparing this intrinsic value with the market price. So when it's come to the equity or the ordinary shares, so you know that in compared to the bonds as well as for the preference shares, preferred stock, when it's come to the equity or the ordinary shares, what are the expected cash flows if you invested in the ordinary shares of the company? What are your expected cash flow? Now in the bonds, coupon, redemption price. So here, if you invested in say equity or the ordinary shares of a listed company, so what are the expected returns? What are the expected cash flows? Basically, dividends, and also you will get capital gains if you sell the shares after particular period. Right. So that is basically dividends. So when it's come to this ordinary shares, you know that some characteristics of the ordinary shares, this represent ownership of the company. So if you invest, if you buy some shares of a company, so you will be a owner. You are a shareholder. You will be a owner, and also you know that not like the bonds, not like the preference shares. For this ordinary shares, there is no maturity. There is no maturity as far as the company is going concerned and they are doing their business. This equity shares are also there. No maturity. But as an investor, you can invest for a particular period. Right? So here, this security valuation we have discussed from the investor perspective. So therefore, you can decide your investment period, or you can keep them for a long term, for a long period. So likewise, you can decide it. And the other thing I want to emphasize when it's come to this ordinary shares, expected dividend is very uncertain. In the bonds, coupon is fixed. In the preference shares, dividend is fixed. But in the equity, the expected dividend is very uncertain because there is no fixed dividend. There are some periods with a large profit, you are getting higher amount of dividends. Some years are there no any dividends. Some periods are there no dividends. So likewise, the dividends depends on company profit, performance, economic condition, director board decisions, available investment. So likewise, lot of factors are affecting for that. So therefore, even though you expected dividends that much, it is very uncertain, high risky. Because of that nature, this equity share valuation somewhat difficult. Not like bonds, the picture is very clear. But when it comes to this equity, expected returns are very uncertain. It is not a fixed amount, it will be variable. So therefore, the calculating of the intrinsic value compared to the bonds and compared to the preference shares, somewhat difficult. Right. So therefore, you know that if you invest in the equity shares of the company, you will be owner, you will have a voting power, you will have certain rights of the company. So because as a owner, so these things you have learned in your levels also. I think no need to spend time. So therefore, that is what I explained. Valuation of the equity share relatively more difficult because first the rate of dividends is not known. As I mentioned, the payment of the dividend is optional. It is not a compulsory mandatory thing, right? So company decides whether this year whether the company is providing dividends or not. That decided by the company. It's optional. And also the estimation of the dividends, the cash flow expected by the shareholders, more uncertain. I think it is clear. Second, the earnings and dividends of the equity share are generally expected to grow. That is the other thing. So you know that earnings of the company is also not a fixed number. With the performance, with the returns, so the earnings are also growing. There will be a growth as well as decline. And also compare in line with the earnings, dividends also change because company might have a dividend policy. So when we say the dividend policy, it includes payout policy and the retention. Right? So our payout means by what is the presentation of paying dividend from the earned profit. So retention means if our payout ratio is 10%, so retention is 90%. So that is the meaning. Yeah? So dividend policy means that is payout then retention ratio. So if payout is 10%, so that means from the earned profit, 10% we give as the dividends to the investors. So then it implies that our retention ratio is 90%. So this is our dividend policy. So then this in line with this earnings of the company, this is also changing. Our dividend payment, retention, dividend policy, they are also not the fixed thing. They are also changing. So because of this nature, so the valuation of this equity share is difficult. Therefore, in the equity valuation or the ordinary share valuation, we have to use different models with a different assumption, right? Under different assumptions. So you can value the equity share based on the dividends. So that is we call dividend discount model. So because you know that for the equity shares there is no maturity, so you are getting dividends for a long period because there is no maturity. So based on this dividend discount model, we can calculate the value. So under the dividend discount models also different scenarios we are going to discuss. And also most popular one, even in the practical world, analysts or the companies are using this price multiples. Right? Based on the market price of the share, different multiples you can construct. So based on these different price multiples, we can calculate the intrinsic value. So basically we are using these two methods. There are some more than these two, economic value added method, market value added method. So likewise some other methods are there. But you should learn only these two. Dividend discount model and the different price multiples. Right, so let's go to this dividend discount model. So when it's come to the dividend discount model, since we are calculating this intrinsic value from the investor perspective, so your expected cash flow consists with the dividend and also some capital gains. Right? As I mentioned earlier, so you might invest for a certain period. There is an investment period, holding period. So during this holding period, you may get some dividends, and also at the end of the holding period, you will sell the shares to another investor. So by selling, you are expecting to get some capital gains. Right? So therefore, there are two types of cash flows associated with the common stock, that is dividend and the expected selling price. Based on that capital gains. The value of the stocks can be calculated simply by discounting the expected next dividend and also expected selling price at the end of your holding period. So that is one way. And also you can calculate the intrinsic value or the present value of the equity share discounting all future dividend payments. Because for the equity shares there is no maturity. So as far as the company is there, you are getting some dividends. So therefore you can consider these two scenarios. One is simply by discounting expected next period dividend and your selling price. So that is intrinsic value. And also if you are investing for a long period because there is no maturity, so then you can calculate the intrinsic value simply by discounting all future dividend payments. If you look at this diagram, you can see these two aspects. Right? If you look at this one, I think you can understand these two methods. Now you know that here P0, current price, value. So value depends on next period dividend and the selling price. Right? P0, if you want to calculate today's price, suppose if you are going to invest for the 1 year, so then your price or the value depends on next period dividend. So D1 is the next period dividend and the next period, end of the next period, your selling price. So likewise again, if you want to calculate next period price, so it is depends on the D2 and P2. And also, if you want to calculate the P2 price in the second year or the after 2 years, so that is depends on the D3 and P3. So likewise, you can continue this for an ultimate surplus. You can continue for any number. This is not the ending process because no maturity. So therefore, Pn minus 1 is equal Pdn divided by, Dn, present value of the Dn and the present value of the price in the period N. So likewise, you can see the two paths. If you are investing for a certain period, considering the selling price, you can calculate the value. If you are investing for a long period, so all the dividends, here D1, D2, D3, Dn, so likewise all the dividends you have to discount and you have to calculate the intrinsic value. So two options are there. As an investor, if you are investing for the long period, so you have to consider all future dividends based on the certain assumption you can calculate. If you are invested for the 1 year, 2 year, like some sort of period, so then you have to consider the expected dividends and the expected selling price. So based on these two behaviors, so the base of going future, the dividends and the prices, so we can identify different models. I think this is not new thing now. I explained that also, right? So in practice, there could be a difference between the present value or the intrinsic value and the market value. You know that. Now with this skill, this point you have learned. So therefore, based on that difference, you can decide whether you buy or sell. If there is the undervaluation, you can invest. If the overvaluation is there in the market, you may not invest. So likewise, the intrinsic value is very important to take the decision whether you invest or not. You should know what is the intrinsic value, what is the fundamental price. Then you can compare it with the market price. Right. So then we are going to with the different models. I told you that this is a very easy topic. So I am starting with the single holding period. Single holding period method. So here single holding period means that single holding period can be 1 week, 1 month, 1 year, whatever the period, that is a single period. So during this single period, you are getting one dividend and also at the end of this single holding period, you are going to sell the shares. So that is why we call single holding period. So the other thing of this one is the multiple holding period. So multiple holding period means if you are keeping for the multiple years, different years. Say you are keeping this stock for the 5 years. So you will get 5 dividends. At the end of the 5 years, you will sell. So likewise, this is based on this part. I told you that you can calculate value considering both dividend and price. And also you can value considering only the dividend. So this is based on the this if you invested for a certain period. You can invest period or period investment stock infinity invest particular period. Single holding period. It can be a day even, 1 day, 1 week. But during this single holding period, you should get one dividend, and also at the end of the period you will sell. So this is very simple. This is applicable when investor hold stock only for one period. That is why we call single holding period. That one period means any duration. That is we define as the one period. After which he sells the stock to another party. So then your intrinsic value, you know the concept, is equal expected dividend in the next period discounted for that period, and also the selling price at the end of the period discounted for the present. So here 1 plus r n, 1 plus r into the power n of this formula. So here n always equal to what? N is not here mentioned, but n always is equal to what? Single period. So n always equal to 1. That is 1. So therefore the value or the intrinsic value is equal. Dividend expected in the next period discounted for 1 plus r into the power 1. This is always 1 at single holding period. So then price P1 discounted for n here 1. So that is very simple. So this one you should note the difference here. R is our discount factor, as in the bonds also are there. So in case of the bond valuation, R we define as the bond holders required rate of return. Bond holders required rate of return. So here when we are calculating the equity value, R is the equity of the common shareholders and the common stock investors required rate of return. Now if I ask the question, which bond is greater, bondholders required rate of return or common shareholders required rate of return, which is greater, which is the highest one? This is required rate of return for the say debt or the bondholders. This is here required rate of return for the equity holders, which is high. Are they same? Why? This is our discount factor. To calculate the intrinsic value, you should know the discount factor. The intrinsic value is not the discount factor. The discount factor is required rate of return. अभी बोल valuation वाले भी required rate of return है करता है ये नहीं ना value में भी आता है और ये तो यहाँ पर now here this is equity shareholders required rate of return. but वहाँ पे भी देखो same are they same? No. Why? I did some other because of what is the reason? Yes, that is this. That is this. I think you can remember the formula. Required rate of return is equal risk-free rate of return plus risk premium. So this risk premium, different assets are having different degrees of risk. So therefore, this risk premium should be aligned with the different degrees of risk. So therefore, required rate of return for the equity shareholders should be greater than the required rate of return of the debt holders because of the risk. Because you know that equity shareholders are the residual owners. They are the owners. What is the meaning of residual owners? In case of this company bankruptcy, equity shareholders have to pay until all the obligations are paid off. First, debt holders, then preference shareholders. Finally, they can get something if remains. So that is the risk. That is the risk. So that is why we call these equity shareholders as the residual owners. We have avashesha aithikam. We have samadhamaka avashesha aithikam or samadhi. So they are the residual owners. In the case of the bankruptcy, in the situation like the financial distress, so they have to wait until all others obligations are settled down. And also think about the other side. In case of the good performing, company is going in the prospect. They are earning large amounts of profit. Who has the right for claim for this profit? Shareholders. Debt holders are कहते हैं company के profit ready अपने वैल्यू interest नहीं देंगे. Preference shareholders are कहते हैं अपने dividend payment के वैल्यू नहीं. No, that is fixed. But when the company is performing well, these equity shareholders are the party getting the benefit of this prospect. That is their return. Their return is high return. So risk के तमा bad category दियो, negative side दियो. The return के तमा company को अंदर perform करा, they will get more dividends. So they are well maximized. Right. Then I think we can do an example. Look at this example. Expo PLC expects to pay dividend 50 rupees at the end of year 1. And the expected price of the stock is 355 rupees at the end of year 1. If required rate of return for the equity stocks 12% per annum, what is the value? What is the value? Very simple. Calculate it quickly. So this is single holding period. What is the value? Yes, value is equal. This is single holding period. So value of the equity share is equal. Next period dividend expected to 15 rupees. Next period selling price expected to 355. So investors required rate of return is given 12%. So you have to discount this expected dividend and expected selling price by this 12%. So this is the price, 330. So this is the intrinsic price. This is the fundamental. This is the price should be according to the fundamentals, according to the theory. So this is you can compare with the market to decide whether you buy or not. Right. So the multiple period valuation. So this one is the single holding period. Now if you invest for a multiple period, so you are keeping these stocks for the more than one period. That is possible. You are keeping these stocks more than one period. So if it is multiple period, so value you can calculate simply here dividend expected in that respective years. So you will get dividends year 1, year 2, year 3, so likewise in the different years, different periods. So then considering these different dividends receiving in the different periods, so you have to calculate its percentage. Then PN is the price you are going to expected to sell at the end of the multiple holding period. So you have to discount it and you have to calculate the value. If it is a multiple holding period, now in this case, in the single holding period, you have only one dividend. That is why we call that the single holding period. In case of the multiple holding period, you will have more than one dividend. So that is you have to discount. relevant to that different period. Quickly look at this. Investor is looking for a 4-year investment, multiple holding period. The CTA shares is selling for 75 rupees. They have plans to pay dividend 750 per share at the end of first and second years, and 9 rupees and 15 rupees respectively at the end of third and fourth years. If the investor requires rate of return 12%, what is the price at the end of fourth year? Share price at the end of fourth year expected to be 70 rupees. So what is the intrinsic value? What is the value of this share? So this is multiple holding period. So we have to consider different dividends. So value of the equity share is equal. Currently the stock is selling for 75. They plan to pay dividend 7 rupees per share at the end of first year and the second year. So then you will expect some dividends 750 in year 1, year 2, 750 first and second years, and 9 and 15 respectively in third and fourth. So you will get 9 rupees in third year and 15 rupees per share dividend in fourth year, and required rate of return is 12%, and the share price at the end of fourth year you expect to be price of the stock in the fourth year 70 rupees. So these are your expected dividends and expected price. So you have to stop. Your required rate of return is given 12% plus so this is the value. So what is the answer? Ninety. 91.1. So you can check. I have no the answer. 91.1 is the intrinsic value. Is it correct? Did you get the same? Any different? 97. And that will be different answers. How about others? are also 4, right? Not the 5. Right, so you have to discount it back for the 4 years, right? I got that. I think there is 73. Yes. So you are intrinsic value here 73. So now if you are going to invest on this CPH company, PLC, what is the decision? Are you investing? The intrinsic value is 73. Currently, the stock is trading for 75. Are you investing? No, because market price is greater than the intrinsic value. So it means that in the marketplace, the stock is now in overvalue. So therefore, you may not invest. If you are already existing investor of this particular company, so you can sell if you have the shares, because now there is an overvaluation in the market. Right? I think that vision is now clear now. Okay. Right. So now we are going to the next model, that is zero growth model. So far we discussed calculation of the equity value considering both dividend and price. So we are investing for a particular period. At the introduction, I told you that for the equity share, no maturity. There is no maturity. So therefore, we have to consider that aspect also. Equity shares වලට maturity ගන්න අපි මේ selling price එක යම් කිසි සීමාවකට දාලා තමයි මේ calculate. This is another way of calculating. I told you that we have to use different ways, different models because of that uncertainty and the nature of the equity share. Here, now we are going to calculate the value based on only the dividends, considering the future dividends. Right? No any selling price, because you know that for the equity shares, no maturity. So therefore, considering the dividends, now we are going to calculate the intrinsic value of the equity share. So first model is the zero growth. Zero growth means for the equity shares, there are some periods companies paying same dividend for a long period. Every year they are paying 5 rupees as the dividend. Right? For the companies also there is a life cycle. When companies are having very stable cash flow, stable earnings, so they might maintain same dividend for a long period. Right? So then you can apply zero growth model. Zero growth means no growth in dividends. හැමදාම එකම ලාභාංශ ගෙවනවා. ඉතින් අපි ඒ වගේ වෙලාවකදී ඒ වගේ අවස්ථාවක් තියෙන්න පුළුවන් කම්පැනි එක හැමදාම රුපියල් 5 ගන්න ඒ ලාභාංශ ගෙවාගෙන යනවා. So the growth is zero. Zero growth of the dividend. So then this could occur when dividend payments of the company are expected to remain unchanged. Then අපි සම්පත් බැංකුවේ shares ගන්න යන්නේ. then අපිට පේනවා මේ කට්ටිය මේ පහුගිය dividend analyze කරනකොට එකම dividend එක ගෙවලා තියෙනවා for a long period අවුරුදු ගානක්. ඉතින් අපිට expect කරන්න පුළුවන් මේ කට්ටිය ඉස්සරහට මේ dividend එක ගෙවාගෙන යන්නේ. So that is our expectation. So then you can apply zero growth model. So in the zero growth model, you will get the same dividend for a long period. So simply, what is the cash flow? In the time value of money, you learn different types of cash flow. So this is what? Annuity. What type of annuity? This is a no maturity. So that again is a perpetuity. Perpetual type annuity. So then you can calculate the value in the perpetuity. You can remember present value is equal periodic payment divided by discount factor. So that is where applying. So in zero growth scenario, so value you can calculate annual continuous dividend divided by investors required rate of return. That's all. Present value of the stock, dividend is the dividend payment, R is here required rate of return. So this is zero growth assumption. Right? හරිද? ඒක අපි දැන් ඉන්වෙස්ට් කරන් යනවා අපිට පේනවා මෙයා හැමදාම එකම ලාභාංශ තමයි ගෙවාගෙන යන්නේ. ඉතින් අපිට මේ මොඩල් එක දාලා ස්ටොක් එක වැලියු කරන්න පුළුවන්. That is the zero. So look at this example. Colombo PLC has just paid a dividend of 6 rupees for last year and expects to maintain the same dividend payment throughout the coming periods. अभी इतना हमें आउट दहा के तो मेरा आवाज़ मेरा ගෙවාගෙන යන්නේ throughout the coming periods. So then if the investor rate of return is 12% per annum, so what is the value? So if you have to take a decision to buy, so you should know what is the intrinsic value. So then in such a situation, you can calculate the intrinsic value 6 divided by 12%. So you will get 50 rupees. This is the intrinsic value, 50 rupees. So you can compare this 50 rupees with the market price. Zero growth model. Right? Zero growth. Next one is constant growth. Constant growth model. So what is that? When the company's dividends growing at a constant growth, right? So they are every year they are increasing dividend at 5%. Right? So dividends could grow at a constant rate when earnings growth and the payout policy of the firm expected to be constant. When company's earnings growth is constant, you can handle that. Earnings is high value. Again, then make up the established company for the demands, sales, established customer base, traction. So likewise, because of these factors, when they are in the saturate point, established saturate point, so then earnings will increase in the constant rate. Earnings, profit. Right? So when the earnings growth constant, as well as the company payout policy is constant. So you know what is payout policy? Retention and payout. Right? When the payout policy is constant, so then you will receive dividends. It is growing at a constant rate. In the life cycle of the company, you know that for the business or the companies also there is a life cycle. Right? At the initial development, growth, matured, saturate. So likewise, there are certain stages in their life cycle. So when they are in the matured, saturate period, so their earnings growth is constant. They can forecast that. Earnings stable earning enough zero. When the company earnings growth is constant, as well as their payout is constant, so then you will get constant increase of the dividend. Dividends and then still marking the dividend. So that is we call constant growth of the dividend. So practically you will face when you are valuing the company in such a situation. Right? So when there is a constant growth in dividends, so you have to apply constant growth model. For this model we are calling it Gordon model. Because this model is identified, initiated by a person called Gordon. So therefore some techniques you can see for this constant growth model, sometimes we are using Gordon model. Constant dividend growth model. Constant growth model. Same meaning. Right. Now if you look at this formula, equation, so calculating the value when there is a constant growth in dividend. DIP or the D dividend in period 1. So this definition is very important because in next with the differential growth rate, we are applying this constant growth model again. What is the interpretation of this DIP1? Dividend payment immediately after the start of the constant growth. Suppose now if the constant growth is starting today, from today onwards, then DIP1 means next period. That is the meaning. Dividend payment immediately after the start of constant growth. Now, in this timeline, so you know that this is 0. So this is today. So it's going 1, 2, 3. So like this. So we are you are forecasting that from today onwards, the company is paying constant dividend. Dividend is paying with a constant flow. So you are forecasting staying here today 0. So then, if you are applying here constant growth model at 0, so then what is the D1? D1 is immediately after the start of the constant growth of the dividend. The constant growth එක මෙතන පටන් ගන්න. එතකොට මේ මොඩල් එක අපි apply කරන්න මෙතන. එහෙනම් අපි ගන්න ඕන මෙතන next period dividend. That is the meaning. Immediately after the dividend payment, immediately after the start of the constant growth. So that is D1. D1 divided by R, equity shareholders required rate of return, G, constant growth rate of the dividend. That is constant growth rate of the dividend. Right? I think it is there, constant growth rate of the dividend. DI1 dividend payment immediately after the start of the constant growth. R is the required rate of return. So you can read that. Constant growth model is most appropriate for mature companies with stable history of growth. දැන් අපිට මේ ඊපෙරේදා පටන් ගත්ත කම්පැනි එකට මේක ඇප්ලයි කරන්න බෑ. නේ? just started මේ history එක අවුරුද්දක් දෙකක් තියෙන කම්පැනි එකට you cannot apply this constant growth model. But for a mature established company, normally in the theory we say that after 5 years time company will become mature. So then for that type of that stage in the stage company, you can apply this constant growth. This is another with another assumption, another way of calculating intrinsic value of the equity share. But you want to make it with because of that complexity, uncertainty about the cash flow, so you have to use different model, one period, multiple period, zero growth. This is constant growth. Right? Okay. Right, look at this example. Come. This one. Alright. Look at the assumption. When you are applying the constant growth model, there are certain assumptions. Based on this assumption, we are applying this constant growth model. Main two assumptions I told you, earnings growth is constant. And also payout policy is constant. In addition to that, the model assumes that dividend paid by the company will grow at a constant rate. I think that is clear. When the dividends payments are increasing at a constant rate, you can apply this model. Stock price will also grow at the same rate. When we are assuming that there is a constant growth in dividend, it implies that price of the company or the price appreciation of the market price in the marketplace, the stock price appreciation also in the same rate. Right? That is happening. And also expected dividend yield is constant. If the market price of the share is constant, so then dividend yield also constant. How to calculate dividend yield? Dividend yield is equal dividend per share divided by market price per share. If the market price per share is increasing at a constant rate, then dividend of the company also increasing at a constant rate. So then dividend yield also stable. Dividend yield also constant. These are some assumptions. Expected capital gain yield also constant. If the price is moving to a same pace, if the price is increasing at a constant rate, so then your capital gain yield also constant. And the expected total rate of return is equal to the expected growth in dividend yield plus the capital gain. So these are some other behind the assumption. Main assumption is there is a constant growth in earnings. That is the main two assumption, and the payout policy of the company remain constant. assumptions main assumptions. In addition to this main assumption, these things are happening in the company when we apply the constant growth model. The constant growth model we apply the basic company. The share price increase in a constant rate, dividend yield constant, price yield constant, capital gain yield. Then required rate of return also in line with the capital gain yield and the dividend yield. Right? Some other assumption. These are some strength and limitation of this constant growth model or the Gordon growth model. This is simple, applicable to stable, matured company, and also G or the growth rate of the dividend. You can estimate using past data, company data. So next, I think we are estimating the growth rate using some information, and also limitation. This constant growth model you cannot apply for the company which not paying any dividend. So company should pay constant dividend to apply the constant growth model. So G or the growth rate, dividend growth rate should be constant. If it is vary with a large amount, so then you cannot apply the constant growth model. Stock value is very sensitive to the required rate of return minus growth rate. So that is normally positive. Theoretically, we say that required rate of return is greater than the growth rate because required rate of return means this includes both dividend yield and the capital gain yield theoretically. So therefore, normally this is a large number. So therefore, this difference should be positive when we apply the constant growth model. Right? So value is highly sensitive to this number. So that is also limitation in constant growth model. Must firms have non-constant growth in dividends? Yes, in practically, dividend payments are not constant. Practically, it can be varied. There are some periods with the high dividends, there are some periods no dividends. So likewise, in practical scenario, the companies are not paying constant dividends, so then you can't apply this model. So these are some limitations and the strength of this model. Look at this example. Hales has just paid a dividend of 7 rupees for last year and expect to increase the dividend payment by 5% each year. So now this is not the zero growth. There is a constant growth in dividend. If return required by the investors or the required rate of return of the investors is 10% per annum, so determine the intrinsic value, determine the present value. So with this available given information, you can apply only the constant growth model. Right? So with that information, you have to apply constant growth model. So according to the constant growth model, so value is equal D1 dividend immediately after the start of the constant growth divided by required rate of return minus constant growth rate. So what is the value? $73.68. You see, 73.68 is the answer. Did you get by others also? Now here, this 7 rupees is what? Just paid dividend. Recently, the company has paid 7 rupees per share. So then, is it a D1 or D0? Is it D0? Just paid. Recently, the company has paid 7 rupees per share. So this is D0 is 7 rupees. So you need D1 to apply the constant growth fund. So if you know the D0, D1 you can calculate. D0 into growth rate is given 5%. So this into 1.05. So how much your D1 then? 7.35. This is 7.35. Divide by required rate of return is 10% minus constant growth rate is 5%. So then is this the answer once you solve this? What is the answer? 0? 147. So I think you did that mistake, no? Right? So this is D0 already just paid dividend. The never company rupiah hara gala here. So your answer is, I think it is 147 correct. Yes, answer is 147. Right? So therefore, please note this very carefully. This is D1. When you apply the constant growth model, D1 is you have to use here. So D1 means immediately after the start of the constant growth of dividend. Now, suppose that any question? Right. And now let's assume that this constant growth in dividends they are maintaining for a long period. They are maintaining constant growth of dividend at 5% each year. Now, can you calculate the value in 10 years? Can you calculate the value of this company share in 10 years because they are maintaining constant growth in dividend? Every year they are increasing dividend by 5%. So I want to know what is the value here? What is the intrinsic value here? This company share in 10 years. There is value at 0 today. This is value at 0. So I want to know what is the value, intrinsic value of this company share in 10 years. That is their way of forwarding. එනම් මොකද්ද මෙයාලගේ value එක company value shares value එක in 10 years. You can calculate by applying this constant growth model. In this timeline, so now if you draw the timeline here, so this is here 0. 0 they have paid 7 rupees. Right? So you calculate the value here by applying the constant growth model. So by considering D1. So I ask you to calculate what is the value of this company shares in 10 years. Value at 10 years. So what you have to do? You have to apply the constant growth model in 10 years. If there is a constant growth in dividend, so you can apply the constant growth model here. So when you apply the constant growth model in 10 years, right? Value of the stock in 10 years. අපි value කරන්නේ stock එක 10ක් කියලා දැනට. එහෙනම් අපි මෙතන ගන්න ඕන next period dividend. Dividend in year 11 divided by required rate of return minus constant growth rate. If I ask you to calculate what is the value of the shares, value of this company shares in 20 years, you can do. Because there is a constant growth in dividend. Dividends you need to calculate D11. When there is a constant growth, you can apply this formula to calculate the dividends in any n period. Dn is equal D0 into 1 plus growth rate into the power n. So you can apply this formula to work out dividend in any n period. If there is a constant growth in dividend, by using this formula, you can calculate dividend in any period. So D11 is equal, D0 is 7 rupees into 1 plus growth rate 105 into the power 11. So then you can work out the level. So then apply the constant growth model and calculate the value. What is the value? D11 is how much? Either D11. That 7 into 11.97. So 11.97 is the D11. 97 divided by required rate of return is 10% minus 0.5. Now look at this in your tutorial, this question number 3. Devadna PLC just paid the dividend 5 rupees per share on its stock. Dividends are expected to grow at a constant rate of 6% per year indefinitely. The investors record rate of return 12% return on the company's stock. What is the current value? What will be the value in 5 years and in 10 years? Just paid, company just paid dividend 5 rupees per share. So then you know that it is D0 5 rupees. Dividends are expected to provide a constant rate of 6% per year indefinitely. So constant growth rate is 6%. So this is application of the constant growth model. So current price of the share, company share is equal, value at 0 is equal, D1 divided by required rate of return is given 12%. So 12% minus 6%. So value in 10 years, not 5 years. So value in 5 years is equal D6 divided by 12% minus 0.6. So value in 10 years is equal D11 divided by 0 minus 0.6. So likewise you can calculate. So D1 is how much? D0 5. So D1 is equal 5 into 1.06. D5 is equal D0 into 1.06 into the power 5. D5 into D6. D11 is equal D0 into 1.06 into the power 11. Right? What are the answers? Can you tell me? What is the value here? 0?
D6. 9.04.
Final answer is 0.
D6, sir.
अब कितना answer दोगे? इतने लिखिए.
59.04.
Here 50.
Yeah.
59.04. कितना लिखिए? The value at today current price. अदर current price को मैंने यहाँ थोड़ा सा. Current price is how much? 180. Yes, sure.
Current price 88.3.
Consider again, no, maybe I should have 18.8. 88.3 current price. Make it about 59 then. 100? 118. Let me see the half, right? So the 115. So with the dividends, you can see price are growing. Right. Next model. So this is zero constant growth, and we discussed zero growth, constant growth. So next one is differential growth. So in the practice, you will have more than one growth rates. Not only on the zero, not only the constant. So in the practical scenario, you will see that companies are paying dividends at different growth rates. In their life cycle at early stages, they are paying dividends at a lower rates. When they are becoming very matured, they are paying dividends at a higher rate, at a super growth rate. So when it become very stable, so they are maintaining constant growth in dividend for a long period. So likewise, there will be a different growth rates in the practical, in the practice in the world. So likewise, you will see they are paying dividends with a different growth rates. They are paying zero growth, constant growth. But in practice, you will see that dividends are growing with the different rates. Initially at a lower rate, then with a higher rate. After certain period, they are paying dividends at a constant rate. So likewise, you will have more than one. Consider the situation where there are multiple growths of dividends. Right? Where there are multiple growths of dividend. Not zero, not constant, but different multiple growths of dividend. So don't worry about this equation or the formula, just forget about that. So with that example, you will learn how to calculate the value of the equation when there is a multiple growth of dividends. Just read this example. John Case, PLC, forecast the following growth rates of dividend. Right, so after analyzing this company's past history, you have identified following growth rates of dividends. The company expects the dividends to grow at a rapid rate, 15% until the end of year 2. Right, until end of year 2. So there we expect paying dividends at 15% for year 1 and year 2 until end of year 2. After which dividends will grow at a rate of 10% for 2 years. So we expect after the year 2, they will pay dividends at a rate of 10% for 2 years. Another 2 years, they will pay at a 10%. After which, it will stabilize to a long run constant growth of 5%. After the 4 years, so then we are expecting company will pay dividends at a constant growth of 5% for a long period. So now you can see there are 3 growth rates of dividend. The recent dividend paid by the company 7 rupees. So determine the present value of this common stock if the investor required rate of return is 12% per annum. So now this is a combination of constant growth as well as the different growth rates. This is very close to the happenings in the practice. Right, so we'll discuss how to calculate the value. Draw the timeline and put the information into the timeline. So you can do that. Draw a timeline and put the information given here into this timeline. So likewise, timeline goes like this. What we expect, the company expects the dividends to grow at a rapid rate of 15% until the end of year 2. So then end of year 2, first 2 years up to this period, so we expect the company will pay dividends at 15% rate. After which, dividends will grow at a rate of 10% for 2 years. So another 2 years, so they will pay dividends at rate of 10% for another 2 years. After which it will stabilize to a long run constant growth of 5%. After year 4, they are maintaining long run constant growth rate of 5% in dividends. The reason dividend paid by the company is 7 rupees. So what is that? D0. Company just paid dividend. Recently the company has paid 7 rupees as the dividend. So this is D0. D0 is 7 rupees per share. Now if I ask you to calculate dividend expected in year 1, year 2, year 3, year 4, can't you do? You can do. Okay? Then grades D0, D0. So you can calculate, you can estimate dividend expected in year 1, year 2, year 3, year 4. So after that, I will explain. So calculate the dividends for the first year 1, year 2, year 3, and year 4. So dividend in year 1, how much? Recently company has paid 7 rupees. It's about 0 to year 1. Dividends are expected to grow at 15%. So then D1 you can calculate this 7% should increase by 15%. 1.15. What is the D1? 8.05. D1 is 8.05. D2. From year 1 to year 2 again dividends are expected to increase by 15%. So then this 8.05 should increase by 15%. D2 is how much? 9.25. D2 is 9.25. D3. From year 2 to year 3, dividends are expected to increase by 10%. So then this 9.25 should increase by 10%. So then D3 is how much? 10.1. D3 is 10.1. D4. From year 3 to year 4, dividends should increase by 10%. So then 10.1 should again increase by 1.1, 10%. 11.2. This is 11.2. Right. Now, dividends for these 4 years you have identified. Alright. D1, Dn is equal to D0 into 1 plus growth rate into the power n. You cannot apply here, right? Then they can apply different growth rates. Constant growth rate is equal to but here you cannot apply one by one. You have to calculate. Now what is happening? After which we expect that company will stabilize to long-term constant growth of 5%. From year 4 onwards to future, so we expect that company will maintain constant growth in dividends at 5% for an indefinite period. That is the expectation. After year 4, so the company will maintain long-term constant growth of dividend for an indefinite period. After we so that is our expectation. Right? So now you are going to invest in the short-term PLC. So you need to calculate it intrinsic value. So now from year 4 onwards, there is a constant growth in dividend. There is a constant growth in dividend. So now what you have to do, you have to value this share because for year 4 onwards, there is a constant growth in dividend. So now in order to calculate the price of this or the value of this dividends in this constant growth period, the constant growth period in order to calculate the intrinsic value. So therefore, what you have to do, you can apply constant growth model to year 4 because after year 4 there is a constant growth in dividend. So you may value this share by applying the constant growth model at year 4. So you should correctly identify the point where we have to value the share. So value of the share at year 4. 5 නෙමේ year 4. අපි value කරන්නේ කොතනද? Constant growth එක හටගන්න ගන්න. So year 4 onwards there is a constant growth in dividends. So therefore now what you have to do, you have to value this share to the year 4. එතන මේ value එකෙන් කියන්නේ මොකද්ද? මේ constant growth එකක් තියෙන period එකේ ලැබෙන ලාභාංශ වල මෙතනට වටිනවා. That is the meaning. Right? From year 4 onwards, there is a constant growth. කොච්චර කාලෙද කියලා අපි දන්නේ. So ඉතින් එහාට constant growth එකක් තියෙන්නේ. ඒතර අපි මේ මොකද කරන්නේ? ඒ growth constant growth period එකේදී ලැබෙන ලාභාංශ වල අපි වටිනාකම constant growth model එක apply කරලා we are calculating the value of that to here. Then මේක දන්නවනේ constant growth model එක අපි discuss කරලා තියෙනවා. So now you can apply the constant growth model to the year 4. To the year 4. So when you apply the constant growth model to the year 4, so you have to take D5 dividend immediately after the start of the constant growth. Constant growth එක පටන් ගන්න තැන ඉඳන් ඊළඟ ලාභාංශය immediately after the start of the constant growth. මතකනේ definition එක. So then you have to take D5. D5 divided by required rate of return minus constant growth. පැහැදිලිද මේක? මොකද ඔයාලා පටල ගන්නේ කොතනද constant ඔයාලා D5 වලට constant growth model එක apply කරොත් that is wrong. මොකද D5 වල නෙමෙයි පටන් ගන්නේ. From D4 year 4 onwards there is a constant growth in dividend. So you have to value the share to the end of year 4. පැහැදිලිද? Right. So now you have to calculate D5. How much the D5? From year 4 to 5, dividends are growing at what is the rate? 5%. Meaning the dividends are from 5%. Right? So then D5 is equal, D4 is 11.2, should increase by 5%. So 1.05. divide by required rate of return is given 12%. Constant growth rate, you know that constant growth rate is 5%. So what is the value at year 4? What is the value of the stock to the year 4? Yeah? 168. So value of the stock to year 4 is 168. 168 value at year 4. Right. Now we have identified all the expected cash flow. If you look at this formula also, it says this story. The formula के කියන්නේ कोई කතන්දරේ. මොකද කියන්නේ A period වල ලාභාංශ ටික identify කරගන්නවා. A ටිකේ discounted price වල එකතු කරගන්නවා. To the point where the constant growth is started, you have to value the share by applying constant growth model. මේ apply කරලා තියෙන constant growth model. A value එක discount කරලා මේකට එකතු කරලා. So that is the intrinsic. Now we have identified all the expected dividends and the price here. May 168 interpret what? Then may 168 interpret what? What may 168 going here? I told you. Value of this expected dividends during this constant growth model to the year 4. अभी मैं assumption लेके मैं constant growth model लेके apply करना තියෙනවා මේ මෙතනින් එහාට ලැබෙන ලාභාංශ වල සියලුම ලාභාංශ වල future dividends වල මෙතනට value වෙනවා 168. This is the constant growth model application. Now what you have to do? Discount all cash flows to the year. This is dividend in year 3. Now in the year 4, 2 cash flows are there. 11.2 dividend is there, and the price or the value of the stock is there. We have value of the share. So both you have to consider and then discount the present. So 8.04 you have to discount it by 1 year. Required rate of return is 12%. That is the discount factor. 9.25 you have to discount for 2 years. 10.1 is the dividend expected in year 3. You have to discount that for 3 years. Year 4, expected dividend is 11.2 plus value of the share 168. Both you have to discount it back for 4 years. Right? 5 minutes for 4 years. So calculate the values here and get the total. Excluding this, right? Make a excluding. D0 already paid. D0 given like that, right? Make it to the net. So excluding D0, so you take the numbers, values, and get the total. If you have any question on this calculation, you can ask, right? Any any unclear things there, please ask. I can explain it again. Right, 135. Yes, 135.7. So now this is the way of calculating value, intrinsic value, when there is a multiple growth of dividends. Right? So dividends for these different periods you have to identify separately. So calculate the present value of these dividends using the required rate of return as the discount factor. So correctly you have to value the share to the point where the constant growth is started by applying the constant growth model. So then that also you have to discount it back to the present. Okay. Right, now look at this ABC PLC share. This is your tutorial. ABC PLC is expanding rapidly. Look at that question. ABC PLC is expanding rapidly and currently needs to retain all of its earnings for reinvestment purpose. Right? Any questions? Ashatina? Right. This is a tutorial section. However, investors expect that ABC will begin paying dividends with the first dividend of 2 rupees, receiving 3 years from today. Dividends should grow rapidly at a rate of 50% per year during years 4 and 5. After year 5, the company should grow a constant rate of 8% per year. If required rate of return is 13%, what is the value of this stock today? Do this yourself. And one of you get a chance, will have a chance to come to the board and put chance. Lucky person will get it. Quick, yeah. Similar type question. I think this is not much typical. I explained very simply. into low, otherwise you are taking too much time. FDC is expanding rapidly and needs to retain all of its earning for the reinvestment. How investors will give dividends, dividend, 2 years, 3 years from today. So 0, 1, 2, 3. In 3 years, you expect a dividend of 2 rupees. From today, the dividend should grow rapidly at a rate of 50% per year during 4 and 5. So then you can identify dividend for year 4, 5 should increase by 50%. So it means this is 3 rupees, this is 450. After which company should grow at a constant rate of 8% per year for a future. After year 5, company should grow a constant rate of 8%. So there will be a constant growth in dividend after year 5 for a long period. So easy, now you can do. So you have to value this share to year 5 or 6. Then the stock value currently. After the 5 years, end of 5 years, the end of 6 years. End of 5. And later, 100 after 5 year 5 will be a constant growth of dividend for a long period. So then you have to value the share to the year 5. So value at year 5 is equal D6 divided by required rate of return minus constant growth rate. So D6 you can work out. 450 should increase by 8%. Divide by required rate of return is 13% minus constant growth rate is 8%. That is the value. How much the value at year 5? 97.2. So you others can check 97.2 is the value. So expected dividends and the expected price is all identified. Now discount them to the present. So this is expected in 3 years from now. So you have to discount it back for 3 years. Right? Not the one. This is for 3 years. Dividend expected in year 4, 3 rupees. You have to discount it for 4 years. Dividend in year 5 for 50 plus value of the share. You have to consider 97.2. Both should discount it back for 5 years. So the total of these values is the answer. Why doesn't have 18.4? How about others? Say it. 58 points. In the middle, 58.4. Do you need a break? Oh, and I continue until the end. Within 10 minutes, right? Because we need to do this one or any other 10 minutes straight. I have shared your assignment details. I think you might have seen it in the LMS. You know that there is some but now I'm or shared your assignment details, group survey. Announcements have to be all the LMS. So you have to prepare for the presentation. What I recommend after dates start on the presentation. Before submission date, all prepare we have a copy decide. I should have zero there. Come back within 10 minutes. ඔය semester එකේ 11 16 ඉවර වෙනවා. එතකොට අපි November first week වගේ second week වගේ වලට assignment මේ presentation එක කරගෙන ඉවර කරනවා. Oh, then we can have according to this level only 16th level ඉවරයි. එතකොට ගොඩක් organization කරනවා. දැන් prepare වෙන්න ගන්න වලට මේ coming to this 4 weeks වලට මගේ එක නැහැ. Right, I'm not coming for the next 4 weeks. එතකොට මේ Mr. Galle sir will take that time. එතකොට වලට මේ දවස් ඒ වෙලාවේ වල full assignment එක ready වෙලා report එක prepare කරන්න. අපි නිකන් submission date එක දාමු මොකද? ඉතින් ඉන්න coordinate වල report submission එක 31st October 1 month almost. It has said 31st October වෙනකොට submission. හැබැයි ඒකට අපේ presentations වලට දවස් 3ක්වත් යනවා. හා? නැත්තම් ටිකක් උඩට ගමු. 31st October report submission. ඒකට ඊළඟ week එකේ ඉඳන් මම presentation ගන්නවා. දැන් groups 5යි අපේ තියෙන 5 groups නේ 5ම එක දවසේ නෙමෙයි දෙක දෙක වගේ කරමු. Mama, instruction you are free to prepare for that. You can present like a short drama, a role play, rather than going with the traditional presentation, because this is some innovative area. So, like say if you take the green bonds, so how to present the green bonds to understand to the layers. You might think in the innovative way. Only I think that is 15 minutes. So you might decide is a role play or now traditional presentation is okay, but I hope some innovative way of doing that. Think about that. Huh? 20 marks for the report and 10 for the presentation. 30. Then with the higher quizzes. 40 for the continuous assessment. Word layer කරගන්න එපා. ඉතින් stress වෙන්න අවශ්‍ය නැහැ. So I'm very flexible in all your requests. So therefore you think about 15 minutes කැමති විදිහකට. එකම දේ you should able to deliver this thing to the audience in an understandable way. So you should read, you should internalize the matter, facts, then you present. You can have a video clips even, then while prior record so you can play that even. That is also acceptable. Already topic සම්බන්ධ මොන හරි issue එකක් තියෙනවා you might ask for me. Now there is a technology AI තියෙනවා දැන් මේව හොයන්න ප්‍රශ්නයක් නැහැ. හොයනවා කියන එක nothing. YouTube දාරවද මේවද ටෙක්නොලොජි AI තියෙනවා දැන් ඔයාලට මේවා දේශි නැහැ. ඒතර ඔයාලගෙන් මම බලාපොරොත්තු වෙන්නේ AI හරි මොනවා හරි source එකක් use කරලා you may read, you may take the knowledge, you have to deliver it. ඒතර properly deliver කරන්න නම් you should have internalized knowledge on that. එහෙම නැතුව ඒක deliver කරන්න බෑ. So I am expecting, I am evaluating that point. කොච්චර දුරට ඒ ටෙක්නොලොජි එක ඒ ටර්ම් එක ඒ ඒරියා එක ඔයා learn කරාද කියන එක තමයි මම assess කරන්නේ. Okay. Oh, exactly. What about the verification like current? But you endingnya kalau ada uangnya nomor besar kita makan makan hasilnya yang lebih baik. Mau akan mau besar sampai mana macam sekarang ini sampai mau pada jam ini. Hello? Dari ఇప్పుడు ප්‍රසාන්ත වාර්තන අර මේ ඉන්දියාවේ මේ ඇප්ලයි කරලා මේක කතා කරලා තියෙනවා මගේ යාළුවෙක් යා මේ යා දැන් අර මේ සර්ටිෆිකේට් එක ඔන්ලයින් සබ්මිට් කරලා තියෙනවා ඒකට වෙරිෆිකේෂන් එක බේසිකලි කරන්න ඕනද කියලා අහනවා ඔයාලා දැන් ගත්තා කිව්වා ඔයා ආන්සර් කරන්නේ නැහැ කියලා මට ගත්තා මේ දැන් ඒක යාට ඔන්ලයින් ඉන්ටර්වියුස් දාලා තියෙනවා එතකොට යා දැන් වෙරිෆයි කරගන්න ඕනද යාට හිතන්නේ පහළ තියෙනවා ඔයාට දැන් කෝල් එකක් ඇවිල්ලා තියෙනවනේ 445 අන්න ඒ නම්බරේ දැන් මට කියන්න ඕනේ දැන් මම ටෙක්ස්ට් කරන්න ඕවා ඔයාට කෝල් කරන්න Good morning. Oh, mari nalin ke kahan terus dia nalin lagi alu, nalin modal kalau terus dia jadi sebagai kawan kami datang membaik tapi cerita wah ini ini boleh presentation kamu tadi bisa dekat kira minimal dekat ke tim kalau ini mau sekarang itu terlalu अगर लंबे गाना बना तो वाला टाइम वेट कराने देखा कर वेट कराने देखे पता कर वेट कराने पता करना ये वेट Right. So in the constant growth model, growth rates were not given. So by looking at the past information of the company using the annual report data, you can estimate the growth rate either using this growth retention model or you can use this one also. According when there is a constant growth in dividend, you know that dn is equal d0 into 1 plus growth rate into the power n. So based on this formula, also you can estimate growth rate. If you solve this formula for the growth rate, this is a very simple computation. So you know that then dn divided by d0 square root of n minus 1 is equal to the growth rate. Right? So dn here, suppose that you are using past 10 years dividend information to estimate the growth rate. So then dn you can take as the current dividend. If you have 10 years information of the dividend, past 10 years, so dn is the dividend per share in year 10. So then d0 is the past dividend per share in the year 1. So then square root of 10. I think this is we are discussing again in cost of capital estimation. So then this is square root of n. From answer you have to deduct 1, so that is the growth rate. That is one way. And also we discussed this one here. So that is growth dividend retention model. According to this, you know that when we apply the constant growth model, company earnings growth is constant. Their earnings are growing at a constant rate. Under this assumption, we are applying this constant growth model. When there is a constant growth in earnings, so we can write a formula for estimation of the earnings next year. Suppose, like say E1. Yes, I will put E1. Earnings next year is equal. Earnings next year is equal earnings this year. This is earnings this year E0. Earnings this year plus retained earnings this year. Retained earnings this year. So retained earnings, you know what is retained earnings? That is from the profit, the retained profit. From the profit you might pay something, that is payout. The balance is the retained earnings. So retained profit, retained earnings this year into return on retained earnings or return on equity. Retained earnings also internal equity. අපි රඳවාගත්ත profit, retained earnings කියන්නේ රඳවාගත්ත profit එකයි equity holders. So retained earnings is the part of internal equity. So therefore this is return on equity or the return on retained earnings. So if there is a constant growth in earnings, so you can forecast next year earnings. Earnings for the next year is equal earnings this year plus retained earnings this year into return on retained earnings. Retained earnings on equivalent. That is by using this formula you can estimate. From this formula you can derive the formula for estimating the growth rate. I will show you the derivation of this one, that is not necessary even. So growth rate is equal retention ratio into return on retained earnings. Right, I will show you how this comes. If you divide both sides of this formula by earnings this year, so that is both sides from the E0. Earnings this year, this is also earnings this year, this term also from the earnings this year. Right, if you divide both sides from this, it will be like this. So then you can solve this. There is a trade-off from here, earnings to earnings, there is a earnings E0 to E0, there is a trade-off, so it will become 1. And also you know that growth of earnings, so you can calculate using like this. In a particular time, the earnings growth, if you need to calculate, growth of earnings is equal E1 minus E0 divided by E0. So this one again you can write like this, no? E1 divided by E0 minus E0 divided by E0. Price appreciation, growth appreciation, appreciation of any variable. Appreciation එක අපිට ලියන්න පුළුවන් P1 minus P0 divided by P0 move. So here earnings growth you can write E1 minus previous earning divided by previous year earning. So then you will have again there is a trade-off. So this will go to the minus 1. Then growth rate will be equal. Actually, this derivation part is not necessary even, right? Growth rate is equal earnings next year divided by earnings this year minus 1. So then once this minus 1 is comes to this side, we minus 1 එක මේ පැත්තට ගන්න පුළුවන්. එතකොට then this will be growth rate plus 1 is equal earnings next year divided by earnings this year. හරිද? එහෙනම් මේ කැලේ here E1 divided by E0. මේ formula එකේ මෙතන තියෙන්නේ earnings next year divided by current earnings. එතකොට for this E1 divided by E0 we substitute with 1 plus growth rate. Again මෙතන. Right? So 1 plus growth rate is equal next year earnings divided by current earnings. Right. Then there is 1. Then may formula this part of this formula you can write like this way also. Retained earnings this year divided by earnings this year into return on retained earnings. So now you can see there is again trade-off to this one to 1. So then you can see growth rate is equal. Then make this year earnings, retained earnings this year. May the current earnings currently retained earnings. What is this ratio? Earnings retained retention ratio. Retention ratio. This is retention ratio. getting a retention ratio. Retained earnings this year divided by earnings this year means that is retention ratio. So retention ratio into return on retained earnings. Either may formula you can use to estimate the growth rate. So growth rate is equal retention ratio into return on retained earnings. So no need to know about this derivation. So this is come with that way. So when you are applying this formula, you will assume that earnings growth is constant. There is a constant growth in earnings. Right. If growth rate is not given, so either you can use this to estimate the growth rate, or you can use this to estimate the growth rate using past dividend information from the annual report. These are publicly available information, so you can estimate the growth rate. Right. So now this is our constant growth model. I think you can remember this. According to the constant growth model, value is equal expected dividend divided by required rate of return minus constant growth rate. So then if you solve, if you rearrange this formula for here for required rate of return, so then required rate of return is equal D1 divided by value or price plus growth rate. So this part D1 divided by value, right? So you can calculate it easily by looking at the market, by looking at the market forecast D1 as well as the price at the value. So then growth rate you can calculate based on this formula. If growth rate is not given, so you can use this model. So growth rate you can calculate is equal retention ratio into return on equity. Return on equity or return on retained earnings. Become a fact. Any confusion? Any clarification? May derivation part just forget about this is formula you can apply, and this one also you can apply. Right. So then in the constant growth model, this part you can get information from the market-based information, from the market forecast. This is also from the annual report. You can work out using this information. Now look at this one. CVL/PS is return on equity. Return on equity. Return on equity or return on retained earnings. Return on equity is 12%. And their retention ratio 75%. And a payout is how much? 25. Retention 75, so payout is then 25%. If the company's payout policy is expected to remain unchanged, so determine the growth of dividends. Growth of dividends for the next year. So then growth of dividends you can calculate. Simply you cannot apply this model because there is no past dividend per share information in this case. So therefore you can't apply this one. But using this retention growth model, you can calculate growth rate is equal retention ratio multiplied by return on equity. It is 9%. It is 9%. Right. If the dividend just paid for the CBL company is 5 rupees, company just paid, recently paid dividend if it is 5 rupees per share, and the value of the stock is 40 rupees, so determine the investors' required rate of return. So value of the company share or the market price, assuming the market division market is 40 rupees, and recently paid dividend is 5 rupees. Right? Recently paid dividend is 5 rupees. So determine the company investors or the equity investors required rate of return. So required rate of return you can estimate using this. This is our constant growth model rearranged one for the required rate of return. So accordingly, required rate of return is equal V1 divided by value or market price plus growth rate. So previously you calculated growth rate for the company is 9%, right? So recently paid dividend 5 rupees. So then you can D0 is 5. Then you can work out D1. 5 should be increased by 9%. Growth rate you work out no, that is 9%. So then D1 is how much? So likewise, by applying this constant growth model using past data, you can estimate the required rate of return. So here the answer is 22.6%. 22.6%. Right, do this one. Wind PLC stock currently sells for 20 rupees per share. Stock just paid dividend is 1 rupees per share and the dividend is expected to grow forever at constant rate of 10%. What is the expected price 1 year from now? What is the required rate of return? Right? Wind PLC is currently sell for 20. Stock just paid dividend is 1 rupee. Dividend is expected to grow forever at a constant rate of 10% a year. What is the stock price is expected 1 year from now? What is the required rate of return? So with application of this model, so you can estimate required rate of return using this model. So stock currently sells for 20 rupees. Stock just paid a dividend of 1 rupee. Is 0 is given, no? Currently sell for 20. So value at 0 is 20. Right? Value at 0 is 20. Just paid a dividend. So that is also D0 is given 1 rupee. Dividend expected to grow at a constant rate of 10% per year. So what is the stock price expected 1 year from now? So you have to estimate value of the stock in 1 year from now, value in year 1, price value in year 1. And also what is the required rate of return? What is, how to solve this? So if you apply the constant growth model, according to the constant growth model, value in 0 is equal next period dividend divided by required rate of return minus constant growth rate. So here the value is given 20, right? In the question you are given the value at 0 is 20. So 20 is equal, D1 is not there, but D0 is given, and also constant growth rate is there. Dividends are growing with the constant rate of 10%. So the method of is the way of method of D1 D0 next period dividend. අපි හොයාගන්න පුළුවන් අපිට D1 D0 දීලා තියෙනවා growth rate එක තියෙනවා එහෙනම් අපි D1 මෙතන හොයාගන්න. D1 is equal 1 into 1.1 divided by required rate of return is not there, but constant growth rate is 10%. So now solve this formula for the required rate of return. You can solve it mathematically. Cross multiplication එක දාලා R solve කරලා ගන්න පුළුවන්. මෙතන එනවා 20 into R minus 0.1 is equal මෙතන එන්නේ 1.1 වලට 1.1 is equal to 1.1 20 R minus 20.1 සමානයි 1.1. එතකොට මෙතන 20 R සමානයි මෙතනට කිව්වොත් ගන්න වෙනවා එනවා 3.1 divided by 20 R into 15.5. That's 15.5. Right. Value in now you can calculate expected value in 1 year from now. So value at 0 is formula is here. So value in 1 year from now is equal D2 divided by required rate of return minus constant growth rate. So D2 you can calculate 1.1 should increase by 1.1 by 10%. So divide by required rate of return we calculated 15.5 minus 10%. That is the answer. Value in 1 year. What is the answer? Twenty, 22. Right. Right. So there are some questions in your tutorial, but anyway, with that time, I am not going to do this thing. But anyway, now you can manage, right? You can manage this one. This is application again the constant growth model. This is also differential growth model calculation. This I think this is be done here. So now we are going to the price multiples. So far we discussed dividend discounting models. So if you recall the things we discussed, we start with the single holding period. So then we discuss with the multiple holding period. If you invested for a particular window, you can calculate value using the single holding and the multiple holding period. But you know that for the equity shares, there is no maturity. So then if you are going to value using the future expected dividends of the stock, so then we can use zero growth, constant growth model and the differential growth model. So we discussed only these three, but anyway there are some more versions even, some more discussions related to this valuation is there, but anyway this fundamental level I will discuss these three models, zero growth, constant and the differential growth model. So with the certain assumption you can apply these models to calculate the value. And also this is dividend discounted models. In addition to calculate the intrinsic value of the equity shares, we can use price multiples. This is very popular one in the real world. These price multiples are used in more frequently with the financial analysts to decide to calculate the intrinsic value. Mostly they are using these different price multiples. What is this price multiples? Actually, this is a very simple thing. Not like you need to discount the cash flows and the things. So simply based on the different variables like price to earnings multiple, price to book value multiples, price to sales multiples. So likewise you can identify different KPIs of the company. So then you calculate this as a multiple related to the price. So then you can have an industry average. And then based on the current earnings, you can calculate the value. I will show you, I will discuss this with the example. So look at this explanation what it says. So far the stock valuation was carried out by considering future cash flows provided to the investor. Another technique for common stock valuation is the comparables using price multiple. This is relative valuation approach where the value of stock is computed, compare value assessed by the market for similar comparable stocks. So by taking the benchmark from the industry or the competitor or the company itself past average you can use. So we are calculating the value. The underlying valuation principle is that two stocks with the identical future cash flow should be traded at the same price. So when you are calculating the price multiples, you have to take a benchmark. Might be industry එක එහෙම නැත්නම් කම්පියුටර් කෙනෙක් ඒකට අපි මෙතනදී assume කරනවා මේ benchmark එක මේ අපි value කරන company එකට it is very identical in the value and the size and their cash flow. So this is a very similar identical type business. So that is based on that assumption we are using different price multiples. So commonly used price multiples are this price to earnings multiple. And also this price to book value, price to sales. Probably most commonly used in one is this price to earning multiple. So what is this price to earning multiples? This is the ratio of market price per share to earning per share. Right? Price to earning multiple. What is the meaning of that price to earning ratio? Then our price to earning ratio को आगे calculate करना भूलना. Price to earning multiple, you can calculate market price per share divided by earning per share. Price to earning multiple. Right? Price to earning. This is market price per share. If price to earning ratio if it is 6, what is the meaning of that? What is the meaning of that? It means for this company, suppose this is for a particular company, so it means that for 1 rupee of earnings of this company, priced at 6 rupees. That is the meaning. Price to earnings. Right? So price to earnings of this company is 6. It means that 1 rupee of this company earnings, the investors in the market are prepared to pay 6 rupees for 1 rupee of earnings of this company. That is the meaning. When this price to earning multiples increasing, it means that the company is very attractive. Company के earnings वलට investors ला ගෙවන්න කැමති මිල. Price to earnings ratio. So based on this multiple, you can multiply. Suppose This is the ratio of market price per share to the earning per share. Market price earning per share of a company for the most recent financial year or past 12 months. So we have to take past average, historical average. Investors use this multiple to compare the company's market capitalization to its earnings. This is measure the price investors are willing to pay. That is the mean price that investors are willing to pay 1 rupee of earnings. So that is 6 rupees. හයක් කියවන්න කැමතියි. උපේන රුපියලකට හයක් price කරනවා. දැන් මේක වැඩි වෙන්න so that is a good thing. It's a good indication. So proxies for this price earning multiple, you can take industry average or the sector average or the company average also you can take. Now look at this example. I think this is very simple thing, right? Galle PLC's common share is currently traded at 80 rupees. Currently, the company share is traded for 80 rupees. The historical average price earning ratio is 10. Historical average කියන්නේ පහුගිය අවුරුදු කිහිපයක price earning multiples වල average එක. Company එකේ. Historical price earning multiples average for the company. මේකට company එකේම average එක අවුරුදු is 10. And the outstanding number of common shares is 3 million. Company again, now the outstanding common shares is 3 million. The reported earnings of the company for the most recent financial year, current most recent financial year, company earnings is 22.5 million. So estimate the value of this common share and determine whether it is fairly priced or not. එතකොට අපිට දීලා තියෙනවා past historical price earning ratio. Company එකේ historical average එක 10. ඊට අවසන වලට දීලා තියෙනවා number of common shares 3 million. Current recently earnings is 22.5 million. මේ ඔක්කොම public data. එතකොට currently other company එකේ most recently financial year earnings is 22.5. එතකොට දැන් අපිට එහෙමනම් දැන් past historical average කියලා කියන්නේ average on average earnings රුපියලකට investors ලා ගෙවපු මිල 10 rupees. එතකොට current earning per share කියන්නේ current earning per share කියද මේ DRPS එකේ 22.5 million is the earnings. 22.5 million divided by 3 million. Then the current earning per share is yes 7.5. Current earning per share 7.5. Past price to earning multiple 10 rupees. So if you know this two information, so then you can calculate value of the company simply past price to earning multiple multiply by earning per share. The making of the කියන්නේ normally on average උපේන රුපියලකට ගෙවපු මිල. ඒතර අද earning per share එක 7.5. එහෙනම් අපි 7.5 earning per share multiply by past company average price earning multiple. So this is the current price. That is the price to multiple. So this is price to earning multiple. The intrinsic value again, this is we call intrinsic value 75. Currently company shares is trading at 80. So what has happened? Under overvaluation. මේ 80කට කිගෙන්නේ. එතකොට based on the price earning multiple, intrinsic value is 75. එතකොට මොකද market එකේ කියන්නේ? It's the overvaluation. Overvaluation, so you may not invest. This is very simple, no need to discount and the things like this. Simply you should know past historical price earning multiple. මේකට අපිට ගන්න පුළුවන් company එකේ average එක ගන්නත් පුළුවන්, industry average එක ගන්නත් පුළුවන්. එහෙම නැත්නම් අපේ competitive average එක ගන්නත් පුළුවන්. For this valuation. Now here, this is the company average, 10. Multiple is 10. Earnings price earning multiple is 10. So, एक क्या है company on average earnings रुपये लग रहा है, earnings रुपये लग रहा है 10 क्या बनो? That is the meaning. है ना earning per share का 7 है. Current earning per share 750. है ना ये तो price है. 750 into price earning multiple 75 rupees. I clear? Huh? So this is easy. This one actually in the real world, practically, एक तो मेडिकल बहुत है. Market का under price चला दो, over price चला दो क्या बना ना quickly calculate करा ले price multiple. Earning based price multiples. So quickly you can calculate. Industry average is already given. If you go to the stock market website, you can have this industry price earning multiples. It is there. So then quickly you can have the profit of the company, number of shares in the company. So you can calculate the company earning per share multiplied by the industry average. So variable here, මෙතන අරන් තියෙන multiple එක තමයි variable එක මොකක්ද? Indicator එක මොකක්ද? Earnings. ඉතින් profit එකට තමයි මේ value කරලා තියෙන්නේ. So likewise you can use different variables. Now this is earnings. Or you can take book value of the equity, or you can take the sales, or you can take another variable to the price. Price එකට අපි index එක හදලා ඊට පස්සේ current value එකෙන් වැඩි කරනවා. So that is the current price. So this is based on the earnings. So we call this as a price earning multiple. Now if you look at this one, book value based. Price to book value. Look at the next one. This is price to book value multiple. Make a price to earning. Millet equity. Then millet book value of the equity. This is the ratio of market price per share to book value of equity. Book value of share of a company as measured on the balance sheet. So this is based on the balance sheet information. So investors use this multiple to compare company's market capitalization to its book value of equity. This measure the price investors are willing to pay for 1 rupee of book value of equity of the company. Company के equity book value एक रुपये लगता है ये वाला करते हैं. जर alternative में company का उपयोग एक लगता है एक रुपये लगता है ये वाला करते हैं. इधर मेथड variable is book value per share. This is earning per share. Different variables. Now suppose Hema's PLCs past average price to book value of equity 9. Past average हो गया हो तो 10 एक 20 का whatever the period. Past average book value per equity 9. කියන්නේ on average balance sheet එකේ එක equity value එකකට book value based equity රුපියලකට 9ක් ගෙවලා තියෙනවා. That is the meaning. The book value of equity as per the most recent financial statement of the company is 18 million. The recent valuation book value of the equity is 18 million. Outstanding number of common shares is 1.5 million and the current market price is 100. So then you can calculate book value per share, current book value per share. Current book value per share is equal, this is recent final book value is 18 million, outstanding number of shares is 1.5 million. And the heart of it, 1.5 million, right? This is book value, rupees million, this is number of shares. So 18 million divided by 1.5 million, so you will have book value per share 12. Okay? Book value per share is 12. The past historical average book value for equity is 9. So then 9 multiplied by current book value per share. So you can have the value of the company share is 108. That is again the intrinsic value. So current market price is given 100. So In the dialogue, are you investing? Yes, now you can invest because there is undervaluation. Intrinsic value is 108, currently trading at 100. So there is undervaluation, so you can invest. If you require, if you are interested, you can invest because there is undervaluation. So this is easy. This is book value based valuation, and also you can use price to sales multiple. This is also a way of variables which are price based multiple. Millet different variables. Price based multiple. Price to earnings, price to book value per share, price to sales, price to whatever income statement based variables indicate. So this is price to sales. This variable sales. Price to sales. The price to sales average calculate current sales per share earning per share, book value per share, method is sales per share. Any question? This is the price based different multiples. Make a most popular one. Most popular one. Quickly you can calculate the value. Other data discount. It may not as a very easy to calculate the value using the price multiple. Which approach is the best? What is the best? Dividend discounted based models or price multiples? What is best? No single ratio can tell investors all they need to know about the stock. Now these are different approaches. If you look at this price multiples, it is important to use the variety ratios to arrive at the complete picture of the company's financial accordingly it says that you can value using dividend discounted model as well as price multiples. If you can use both before taking the decision, that is better. That is based on the expected dividend. This is based on the current price based multiples. Most popular one is price multiples, price based multiples. But fundamentally, theoretically, most sound, most fundamental accepted one is dividend discount model because it is more consistent with our objective of financial management. Our objective is value maximization. Expected cash flows to the present value. So fundamentally, this dividend discount based method is fundamentally good, very strong. But popular, most frequently used one is price based multiple. Both are good. Better to use both before taking the investment decision, dividend based valuation as well as price based multiples. So that is the end of the equity valuation. So next one is preference share valuation. Last point. Any queries on these price based multiples? Terma? You take yard something of the Terma. Look at I think one of the questions might be this is very simple, I think. Anyway, that is very simple method, but it practically more important one. So you can use that also. Any question before going to the preference share valuation? Right. There is few things we have to discuss related to this. Preferred stock valuation. As I explained at the beginning, the difference between the common or the ordinary shares and preferred shares is what? What is the difference? Anyone? Difference? When it comes to the equity share, expected dividend is very uncertain. It is not fixed. Okay? And also there is no maturity for the equity, ordinary shares. But when it comes to these preference shares, dividend amount or the dividend is fixed. They are based on the face value. Similar to the bond valuation, some features are same like the bonds. For the preference shares also there is the face value and also the redemption price at the maturity. So throughout this period until the maturity, you are getting fixed income, right? So if you compare the preference shares with the ordinary shares based on these factors, claims, in case of the bankruptcy, in case of the financial distress situation, they have priority. Before the equity shareholders' obligations, they can ask their dividends, they can ask their investment redemption price in case of the bankruptcy. And also the dividend is fixed. I told you, they are having the dividend fixed amount. You can calculate based on the face value. Redemption, yes, there is a redeemable time, but anyway there are different categories. I think you remember, you might have learned in the A-levels, there are some redeemable preference shares as well as unredeemable. Unredeemable means no maturity. In case of the preference shares also, there are some categories, no redeemable or no maturity. So no maturity means as far as the company is surviving, company is doing their operation, they are also getting a dividend. But the difference between this and the equity share, their dividend is fixed. They are getting fixed dividend. Equity shares, ordinary shares, dividend is variable. Maturity එකක් තියෙන්නත් පුළුවන්, maturity එකක් නැති වෙනවා. අපි කියනවා redeemable and unredeemable. Unredeemable means no maturity. Redeemable means there is a maturity. Conversion. Some features can be there. When a company is issuing preference shares, they might have some option. After a certain period, these preference shareholders can convert into equity shares. So that kind of rights, that kind of features can be there with the preference shares when the company is issuing. Conversion kind of thing. So some features related to the preference shares. So we are going to the calculation of the valuation. If it is redeemable, I think I explained this one. So this is the formula. If it is redeemable, you can consider the annual or semi-annual dividend you are receiving as an annuity. In the bonds, that coupon was the annuity cash flow. In case of these redeemable preference shares, the dividend you are receiving until the maturity is the annuity. Say fixed dividend. At the maturity, you will get the face value. Bonds at the maturity you will get the redemption price, redemption payment. So in this case, always redemption payment is equal to the face value. In case of the bonds, face value is 1000. In case of the preference shares, face value normally 100. We take it as a 100. This is the model that you can apply when the preference shares with the maturity. Maturity redeem කරන්න පුළුවන් යම් කිසි වෙලාවකදී ඒක අපි නිදහස් කරනවා. අපි කියන්නේ නිදහස් කරන එක වර්ණය කොටස් කියන. That is the redeemable. You can see R here, Rika rate of return for the preference shareholders. Rika rate of return for the preference stock. That's all. So this is the model for calculating intrinsic value if it is redeemable, if it is with the maturity. Now look at this example. We'll do quickly. I will take only the 10 minutes, not the 10 minutes, 5 minutes. Right. Calculate the value here. Whether they want to learn nothing, just you have to do. When the preference shares is redeemable, so value or the intrinsic value is equal value of the preference shares. So here you can see ACL company has issued preference shares 100 rupees par with the 12 years to maturity. Par value, face value 100 rupees. Time to maturity 12 years. It pay dividend 10% annually. Either 10% we calculate based on the face value. Either face value එක par value එක 100. So then how much the annual dividend? रुपया 10. Annual dividend is 10 rupees. So this is an annuity. මේ රුපියල් 10 කියන්නේ හැමදාම වාර්ෂිකව හම්බ වෙන cash flow. So it's an annuity. Then you have to calculate present value of this annuity. So you know the annuity factor formula. So this is 1 minus 1 plus r into the power minus n divided by r. So what is the r? Investors require rate of return. At the redemption, at the maturity, you are getting face value. So this is 100. 100 is a single lump sum payment. So you have to discount with 1 plus r into the power n. That's all. So here 12 years, then 10 into 1 minus required rate of return for the investors 11% minus 12 divided by 11. Here 100, 11% times 12 years. That is the answer. If it is redeemable, this is the way of calculating intrinsic value. Is it 93.5? Yeah, that is the intrinsic value. Like the bonds, teachers are saying. Difference between the bonds and the preference shares, the risk for the preference shareholders is high compared to the bond holders. Because in the bankrupt situation, debt holders, bond holders have priority than the preference shareholders. In the යාළගේ risk එකට වඩා මේ preference shareholders ගේ risk එක වැඩි. Because of that, at the bankruptcy they have the priority before the debt holders has the priority. Right. If it is unredeemable, no maturity. Unredeemable means no maturity. So as far as the company doing their business, so the preference shareholders also getting the fixed dividend. And the fixed dividend. So again, this is an annuity. What is the type of annuity? Perpetual type annuity. Is a perpetual cash flow. So then you can calculate the intrinsic value if it is perpetual or the unredeemable preference share, simply annual dividend divided by investor required rate of return. That's all. DPL pays 15% dividend for the perpetual preferred stock. Perpetual preferred stock means no maturity. That is unredeemable. Maturity got flat. So they are paying 15% dividend. Par value is 100. So then you are getting 15 rupees annually. And the damn share power if the investor required rate of return is 10%, what is the value? 15% divided by 10%. So that is equal to 150. That is end of security valuation. So next is risk and return. Right? Risk and return. So when I come to the next lecture, to the risk and return, you will have a quiz based on the security valuation. I will announce in the LMS, so it might take time. Be ready for the group assignment also. If anything you have, you can communicate with me. So then, do like this. Any questions, any clarification? Zero or then, or huh? Certainly not. Good, good. Any questions, any clarification? I have taken you 20 minutes ago, but anyway, you came 8:30. Any questions? You have another lecture.